Realty Income and NNN REIT are two of the most popular REITs in the world, and it's pretty simple to understand why. They have both managed to grow their dividends for many decades in a row, even despite the dot-com crash, the great financial crisis and the pandemic. Realty Income has now grown its dividend for about 29 years in a row, and NNN REIT, which is a bit less famous, has actually grown it for even longer, for 32 years. Then on top of that, both have also massively outperformed the broader market on a total return basis, generating roughly 15% annual average returns since going public. As a result, I often get questions about these two REITs, and a common question that I get is, which is the best to buy today, Realty Income or Triple Net REIT? Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm gonna explain to you why I think that Triple Net REIT is a slightly better investment opportunity in today's market. But before I get into it, could you please do me a favor and like this video? It really helped me a lot to grow this channel. Thank you very much. And then secondly, I also want to remind you that Seeking Alpha has now reactivated the 2-week free trial for my REIT newsletter, High Yield Landlord. I'll put a link to it somewhere in the description of this video. So the reason why I slightly prefer NNN REIT over Realty Income today is very simple. I think that it offers a better combination of yield, value and growth. Today its dividend yield is about 10% higher, so not a really big difference, but its valuation is also about 15% lower, and despite offering a higher yield and trading at a lower valuation, I actually expect it to also grow faster in the coming years. To demonstrate why I think that NNN REIT is going to grow faster than Realty Income, it helps to take a step back and review how REITs are able to grow and what factors play an important role. REITs can really grow in two ways. They can grow internally or they can grow externally. Internal growth is whatever growth REITs are able to achieve internally, which means without raising additional equity capital in the public market. Therefore, important factors to consider here include the rent escalations in the leases, the occupancy rate of the REIT and whether it has potential to grow over time, how much cash they retain, so their payout ratio, and then finally also capital recycling opportunities. So is a REIT able to sell assets at X cap rate and then use these proceeds to buy properties at a higher cap rates to grow again without raising additional equity. For triple net lease REITs like Realty Income and NNN REIT, I think that the two most important factors for internal growth are your payout ratio, so how much cash you retain, and then the lease escalations that you have in order to grow your rents. And from both of these perspectives, NNN REIT is superior to Realty Income at this time. Its payout ratio is slightly lower at about 70% compared to 76% for Realty Income, and its rent escalations are about 2% compared to closer to 1.5% for Realty Income. So from an internal growth perspective, I think that NNN REIT is superior. But what about external growth? External growth is whatever growth REITs are able to achieve externally, which means by raising additional equity in the public market to buy more properties. A lot of very successful REITs like Realty Income are able to grow externally because their cost of capital is typically inferior to the expected returns of their investments, and as such they're able to keep on expanding their share count, raise more equity, buy more properties and grow on a per share basis. To give you a simple example here, if let's say your blended cost of capital including equity and debt is 5% and you're able to use this capital to buy properties at a 7% cap rate, then you're gonna earn a 200 basis point spread, which is going to lead to FFO per share growth and dividend per share growth even despite the expanding share count. So which REIT is superior from this perspective? Here the three most important factors to consider are your overall cost of capital, the expected cap rates that the REITs are able to get on the acquisitions, and then thirdly also the size of the REIT. Here it's a bit more complicated to determine which of these two REITs is better positioned for external growth because both have pros and cons. On one hand, Realty Income has access to slightly cheaper capital because its equity is trading at a higher valuation, which lowers the cost of equity, and then secondly it has a slightly stronger balance sheet and investment grade rating, which allows it to access capital at a slightly inferior cost, especially because it's also operating in Europe where interest rates are quite a bit lower than in the US. However, on the other hand, hand, NNN REIT, while its cost of capital is slightly higher, it's also able to target slightly higher cap rates on its new acquisitions. NNN REIT is a smaller REIT and it's able to play in a niche of the triple net lease market that enjoys higher cap rates because there's less competition for them. But that doesn't mean that these properties are any riskier than what Realty Income is buying. It's just a different approach. What NNN REIT is here doing is it's really underwriting heavily the property level profitability of its tenants and relying on that to minimize the risk of lease delinquencies. Currently, NNN REIT is able to get cap rates in the low 7th, mid 7% cap rates, and in comparison, the cap rates of Realty Income are typically about 50 to 100 basis points lower. So I don't think that any of these REITs has really a strong advantage from the perspective of their cost of capital or their acquisition cap rates. The spreads are relatively small in today's market anyways. However, I will still give a slight edge to NNN REIT because of its much smaller size. Realty Income is one of the biggest REITs in the world with a market cap surpassing 40 billion. NNN REIT is not small either, but its market cap is only about 8 billion, so more than 5 times smaller. And I think that this is really a major advantage when it comes to external growth. As a REIT gets really large, eventually it becomes a disadvantage to grow externally because it forces the REIT to buy a huge amount of properties every quarter just to keep the ball rolling. NNN REIT, on the other hand, still isn't quite that large, and so each new acquisition moves the needle quite a bit more than Realty Income, and so because of this, I think that its external growth prospects are going to be superior over the next 10 years. So to recap here, I think that NNN REIT is going to be able to grow faster internally as well as externally, and I think that overall its growth rate is likely going to be about 20% higher than that of Realty Income. I expect Realty Income to grow its FFO per share by about 4% per year over the long run, whereas I think that NNN REIT should be capable of growing at closer to 5 or even 6%. But despite that, it's today offered at a lower valuation, a higher yield, and so because of all of this, I think that it's a better investment opportunity today. And now, if you want to learn more about what else we are buying in the REIT market today, feel free to join my REIT newsletter for a 2-week free trial. I'll put a link somewhere in the description of this video. It will give you immediate access to my entire real money REIT portfolio. And then once more, if you could please also like this video, that will really help me a lot to grow this channel. Thank you very much for your support and see you at my next one. Bye bye.